We're in Chapter 9, Objective 9.3, Analyze and Differentiate Financing with Debt versus Equity. This is really a 35,000 foot view just to stick your toe in the water, to just think about the big moving pieces. You have a company providing a service or providing a good, and they need to grow, they need capital. Well, there's basically three ways to do it. There's two ways outside and one way inside. First, outside financing sources, just broadly speaking, you can issue stock, which is equity, and the benefits are that there's low risk. If you have no debt, in the extreme, you're all equity, you can't go into bankruptcy. Now, can you lose money? Yes, but bankruptcy means when a creditor takes a debtor to court to force liquidation of assets or other actions under debt contracts. The problem with issuing equity is it's a really expensive source of financing. If you have a profitable company, expect to have high returns, and you have 50% of the stock. If you're going to do an equity offering, say that would double the number of shares outstanding, you'd be giving up your claim to half that profit. So equity tends to be, even if it's lower risk, lower risk in terms of the corporation, higher cost. Issuing bonds will increase your financial risk, so it increases leverage. Any time if you go through a rough patch and you can't make payments, you're at risk of your creditors swooping in and taking your assets. The benefit is that it's cheaper than stock. Then there's inside financing, which is free cash flow, which is generally thought of to be the cheapest form if you have it. So it's not always available. So in a weird situation, even profitable companies that are growing very, very quickly, they don't have enough free cash flow to fund their growth. So you need this working capital as you grow, but your company, it's unlikely to be so profitable that it'd be kicking out enough free cash flow to finance all its growth. All right. There's a general rule of thumb that if your ROA is greater than the interest rate on debt, then borrowing will increase earnings per share and return to shareholders. You're really definitely, whenever your ROA is greater than your interest rate on your debt, you're almost certainly going to want to increase your lending within some margin of safety. But because every company has its own risk profile, it's a little more complicated in the real world. We're not going to do a full-blown case here. So you just have to be aware of the trade-offs, that if your company has a very steady stream of cash flow and net income, then your borrowing potential is larger than the same size company that has a lot of ups and downs in its cash flow. Okay, so here's an example. So this company is going to borrow $3 million, and this is the debt financing plan. Here's the equity financing plan. Either way, they need $3 million. The net income before was $500,000, and the gross income to this project is $600,000. On the debt side, you get to deduct your interest expense, and I think this looks like 6% interest. Income tax at a 40% rate, so you get to keep $252,000. Over here, you don't get to deduct the interest, so your taxes are a little higher, but your estimated net income is larger because you didn't have the interest. Okay. So the total company net income is larger over here with debt than with equity. All right. But however, that looks great, but you had to give up 50,000 shares, and the company had 100,000 shares before. So now you've diluted it 1/3. So if you're a shareholder, you have to share that income. On the debt side, yes, your income's lower. Earnings per share of the project is higher. Earnings per share before the project was the same for both. Afterwards, the combined is much higher with debt. So this debt is the clear winner from the shareholder perspective. All right. I would like to point out, though, that actually the ROA goes down when you combine it over here. It was 10% before. This has a higher ROA. All right. So not every metric improves, but generally what shareholders will want is more income per share. So even if the ROA metric is declining, so you're kind of eating into your higher level profitability, if you can keep increasing this, as long as you have positive net income, firms may continue to take those projects. Okay? So just a really simple view of debt versus equity financing. Not a lot of the complications that you'll see in real life, but it gets you to see the trade-offs between issuing shares and the existing shareholders having to decide whether to split future profits with new shareholders, or issuing debt and not diluting ownership. Of course, if the current owners are just going to put more capital in, they may not care about that, because if they look at their total return for their number of shares, it would be the same. So those are the kind of things I'm talking about that come into play. Like, are these new or old owners? If it's a big company, odds are it's going to be new owners, because there's not a lot of people with a large amount of capital. But if it's a small family-owned company, they may just be taking more family money and investing. Okay? So that's looking at a case of financing with debt versus equity. In the next part, we'll get into the ratios.